Welcome to Smart Money Trade Ben FX.
In this video, I'll be sharing a simple yet profitable smart money trading strategy. What if you could finally stop trading against the market and start trading with the smart money? In this video, I'm going to show you 3 powerful smart money trading strategies that institutions use every single day. Strategies that go far beyond basic support and resistance. You'll learn how to spot and trade the power of 3 pattern, used to trap retail traders and create explosive moves. RSI divergence combined with liquidity sweeps, a deadly combo for catching reversals early. And the breaker block, a hidden level most traders overlook but smart money uses to re-enter the market with precision. Whether you're trading forex, crypto, stocks, or indices, these strategies will help you think and trade like the pros. Let's kick things off with the first strategy, and it's a big one. It's called the power of 3, and it's one of the most effective smart money concepts out there. This strategy breaks down price action into 3 distinct phases: accumulation, manipulation, and expansion. It's a blueprint for how institutional traders operate. They build their positions, trap retail traders, and then launch price in their intended direction. Understanding these phases helps you avoid fakeouts and trade in sync with the smart money, not against it. Let's break down each phase so you know exactly what to look for. Consolidation. During the consolidation phase, the market moves sideways in a tight range, giving the illusion that there's no clear direction. But behind the scenes, smart money is quietly accumulating or distributing positions. This calm, range-bound action is the foundation for the bigger move that's about to unfold. Manipulation. This is where the trap is set. The market fakes a breakout above or below the range to trigger stop losses and lure retail traders into bad positions. It's a classic liquidity grab. Smart money hunts for orders resting above resistance or below support before reversing the move. This phase clears the board and sets up the real direction that follows. Liquidity sweep. A liquidity sweep happens when price breaks below a key support level, only to snap back into the range moments later. This false breakout is no accident. It's a move designed to trigger stop losses and trap breakout traders. Once smart money collects enough liquidity, the market quickly shifts direction. That's the start of the acceleration phase, the real move. As smart money traders, our goal is to catch this phase, entering right after the stop hunt, when the momentum is fueled by trapped traders exiting their positions. Acceleration. This is where the real move begins. After triggering stop losses during the liquidity sweep, smart money unleashes momentum in the opposite direction. Price moves rapidly, leaving retail traders who fell for the trap behind. This is the ideal moment to enter, right after the manipulation, so we can ride the wave created by smart money and capitalize on the momentum that follows. The power of 3 is built on 3 phases: consolidation, manipulation, and acceleration. This pattern is a clear blueprint of how smart money moves the market. First by building positions, then by trapping traders, and finally by driving price with strong momentum. If you can recognize these phases and time your entries during the acceleration phase, you'll be trading alongside the smart money, not against it, and positioning yourself to catch high probability moves. Let's look at how to actually trade the power of 3 in both bullish and bearish markets. When the market is in an uptrend, smart money will eventually begin taking profits. This leads to a distribution phase, where price starts moving sideways in a tight range. Here's how to trade it. First, wait for a clear range to form. This signals that institutions are offloading their positions. Then comes the liquidity sweep, a false breakout above the range that grabs stop losses. Once price returns back inside the range, that's your signal. Enter at the close of the candle that re-enters the range. Place your stop loss above the recent high. Set your target at the next key support level. This allows you to catch the acceleration phase, also called the markdown, where price drops rapidly after the trap. In a downtrend, smart money is looking to buy at discounted prices. This begins with the accumulation phase, where price starts to consolidate in a range. Here's how to catch the upside move. Watch for the range to form. This is smart money building long positions. Then, wait for the liquidity sweep, a false move below support to trigger stop losses. Once price comes back into the range, that's your entry setup. Enter at the close of the candle that closes back inside the range. Set your stop loss below the recent low. Target the next key resistance level. This positions you to ride the acceleration phase, or the markup, as price surges higher after the trap. Now, let's break this down on a real chart so you can see exactly how the bearish power of 3 plays out. We start with an uptrend. Buyers are clearly in control, and price is making higher highs. But then the market starts to move sideways, forming a range. This is our first clue. At this point, price could either break higher and continue the trend or reverse completely. As smart money traders, we stay patient. We're waiting for a false breakout above the resistance. And that's exactly what we get. Price breaks up inside the range. That's your liquidity sweep, and it confirms the manipulation phase. This is a textbook example of the three phases: distribution, manipulation, markdown. Here's how to trade it. Enter at the close of the candle that returns inside the range. Place your stop loss just above the high of the breakout candle. Your target, the next key support level. Now, look at what follows. Price drops fast and hard. That's your acceleration phase, or markdown. This is where smart money exits their long positions and flips short, driving the market lower. By learning to recognize this setup, you'll start to see where smart money is loading and unloading positions, and more importantly, how to profit from it. Now let's look at another real chart. This time, we're dealing with a downtrend. Sellers have been in control and price has been making lower lows. But suddenly, things change. The market starts to consolidate, forming a sideways range. For smart money traders, this is a key signal. It shows that sellers may be losing strength and smart money could be preparing to buy. Then it happens. Price breaks below support, sweeping liquidity, and then closes right back inside the range. That's your liquidity grab, and it's a strong sign of manipulation. Now you can clearly spot the three phases: accumulation, manipulation, markup. Here's how to trade this setup. Enter at the close of the candle that comes back inside the range. Place your stop loss just below the breakout candle. Set your target at the next key resistance level. What happens next? The market takes off to the upside, exactly as expected. This is the acceleration phase, or markup, where smart money drives price higher after trapping sellers. By mastering this pattern, you'll learn to spot when the market is being manipulated and how to position yourself to trade with the smart money, not against it. What if I told you there's a way to spot market reversals before they happen, using nothing more than a simple yet powerful tool? That's exactly what RSI divergence helps you do. And when you combine it with smart money principles, this strategy becomes a high probability weapon in your trading arsenal. Let's break it down. Divergence happens when price is telling one story, but the RSI is quietly telling another. It's like catching the market whispering its next move before it becomes obvious to everyone else. And there are two key types of divergence. Bullish divergence. This occurs when price forms lower lows, but the RSI forms higher lows. That's your first clue that sellers are losing momentum, and a bullish reversal could be just around the corner. Pro tip: when drawing the lower lows on your chart, always use the candle bodies, not the wicks. It gives a more accurate read of market structure. Bearish divergence. Here price makes higher highs, but RSI prints lower highs. That's a sign that buyers are running out of steam and a downward move may be coming. Pro tip: again, stick to candle bodies when connecting the highs. Wicks can be deceiving. The real power of divergence comes from the RSI's ability to reveal hidden shifts in momentum, changes that price action alone might not show right away. And when you spot divergence near a key supply or demand zone, or after a liquidity sweep, it becomes even more powerful. That's how smart money uses divergence, not on its own, but as confirmation to enter when the odds are stacked in their favor. Let me walk you through how to trade this strategy step by step. On the 5-minute chart, notice what's happening. Price is making a lower low, but the RSI is printing a higher low. That's your classic bullish divergence, signaling that the downtrend is losing steam and buyers may be stepping in. Now, divergence alone isn't enough. We want confirmation. Look at the price action. We've got a bullish engulfing candle showing that buyers have just overpowered sellers. That's a strong signal that momentum is shifting in favor of the bulls. But we don't stop there. We jump to the 1-hour chart to get the bigger picture. And what do we see? The market is in a clear uptrend, strong impulsive moves followed by healthy pullbacks. According to market structure, this current pullback is likely to be followed by another leg up. That higher time frame alignment gives us added confluence. The smart money is likely preparing to push price higher. Now let's return to the 5-minute chart and set up the trade. Enter at the close of the engulfing candle. Place your stop loss a few pips below the low of that same candle. For your target, aim for the next key resistance level, making sure your trade offers at least a 2-to-1 reward to risk ratio. By combining RSI divergence with smart money confirmation and multi-time frame analysis, you're not just guessing, you're stacking probabilities in your favor. Now, what if we could make this strategy even more powerful? By combining divergence with smart money concepts, you can take your trading to a whole new level, increasing precision and filtering out false signals. Let's break this down with a real chart example. Price approaches a clear resistance level, breaks just above it, then snaps back below. This is a textbook liquidity sweep. Smart money triggering breakout buys and stop losses before reversing direction. Now check the RSI. While price made a higher high, the RSI made a lower high. That's your bearish divergence. Momentum is fading even as price pushes up. At this point, we have two powerful signals aligning: a liquidity trap just above resistance, a smart money move designed to shake out retail traders. RSI divergence confirming that momentum is shifting to the downside. Let's take this a step further and check the 1-hour chart. On the higher time frame, price is range-bound and just got rejected from a supply zone. This confirms our short bias. There's a good chance the market will continue lower. Now, let's return to the 5-minute chart to plan the trade. Here's the trade setup. Entry, at the close of the candle that falls back below resistance after the sweep. Stop loss, just above the wick of the candle that broke out. Target, the next support level, ensuring a minimum 2-to-1 reward to risk ratio. This is how you combine divergence, liquidity traps, and market structure across multiple timeframes to trade like smart money. Now, let's move to the last trading strategy, and it's a game changer. We're talking about the breaker block. A breaker block is what forms when an order block fails, usually after a liquidity sweep or a market structure shift. It's a core concept in smart money trading, and often becomes a highly reactive level, acting as either support or resistance once price has broken through it. Here's the idea. An order block is a zone where smart money previously entered the market, typically causing a strong move. But when price comes back and doesn't respect that level, meaning it breaks through it instead of reversing, that zone becomes a breaker block. In other words, a breaker block is a failed order block that gets recycled by smart money to trap traders and fuel the next move. To understand why breaker blocks are so effective, we need to look at the psychology of trapped traders and how smart money uses these zones to their advantage. Here's the scenario. Price breaks above a recent high, signaling a potential shift and forming a valid bullish order block. Many traders go long here, expecting the demand zone to hold, but then the market shifts structure. It breaks below the most recent low, signaling a bearish move. At this point, the original demand zone fails, and what once looked like a strong buy area now becomes a breaker block. A former support zone flipped into resistance. Now think about the traders who went long at that order block. They're trapped. As price pulls back toward their entry, many of them are just hoping to get out at break even. The moment price returns to that zone, these traders start closing their positions, adding sell pressure to the market. But that's only part of the story. At the same time, banks and institutions recognize this failed level as a new point of interest, a breaker block. They use it as an opportunity to re-enter short positions, adding institutional selling momentum just as retail traders are exiting their longs. This double effect, trapped longs exiting and institutions selling, creates a powerful bearish reaction, reinforcing the breaker block as a highly reliable level. That's why breaker blocks work so well. They're not just technical zones, they're psychological battlegrounds where smart money dominates the game. Okay, now let me show you a chart example that brings together all the key criteria for spotting a valid breaker block in action. We start with a clear swing high followed by a swing low. Then the market makes a strong bullish move, breaking and closing above the previous swing high. This confirms a valid order block, signaling heavy demand and smart money interest in long positions. At this point, price has taken out buy-side liquidity above the highs, but instead of continuing upward, the market suddenly reverses, despite forming a new higher high. This is the turning point. Price begins to drop aggressively and eventually breaks and closes below the low of the last bearish candle in that bullish sequence. This confirms a market structure shift, from bullish to bearish. Now that the structure has shifted, the original order block fails, and it transforms into a bearish breaker block. That same demand zone is now acting as resistance, a trap for buyers who entered earlier and are now stopped out or hoping to break even. What happens next? Price revisits the breaker block, stalls for a moment, and begins accumulating more buy orders, likely from traders expecting another bullish bounce. But this consolidation is short-lived. The market gains momentum and resumes its downward move, validating the breaker block as a powerful reversal zone used by smart money to reload short positions. This is how you use structure, liquidity, and breaker block logic to align your trades with institutional footprints and avoid getting trapped like the crowd. Let's walk through a real chart example that shows a bullish breaker block playing out step by step. We begin with the market trending downward, forming a swing low. Then comes a brief push upward followed by another drop. This second leg down creates a bearish order block, a sign that sellers were in control and pushed price lower. But here's where things get interesting. Step 1. Liquidity sweep. Price dips slightly below the previous low, clearing out sell-side liquidity. This sweep takes out stop losses from retail traders who had long positions below that swing low, a classic move by smart money to grab liquidity before reversing. Step 2. Sharp bullish reversal. Immediately after the sweep, price launches upward with strength. This isn't just a minor bounce, it's a clear shift in momentum. The aggressive move shows that sellers are exhausted and buyers are stepping in hard. Crucially, this move closes above the bearish order block, confirming that the zone failed to hold as resistance. That failed supply zone is now flipped into a bullish breaker block, a powerful level where smart money may look to re-enter long positions. Now we wait. This is where patience pays off. Price eventually pulls back to the breaker block, which is now flipped from supply to demand. As it revisits this level, we're watching closely for a sign of rejection. In this case, we get an inside bar, signaling accumulation, a sign the market is preparing for another leg higher. This gives us our entry at the close of the inside bar that forms inside the breaker block. For our stop loss, we can place it just below the low of the breaker block zone. For our take profit, we can place it at the next significant resistance level, ideally with at least a 2-to-1 reward to risk ratio. This kind of setup gives you the confidence to trade with the smart money, using a combination of structure, liquidity, and confirmation.
Thanks for watching. Don't forget to subscribe for more insight.